Okay, let's talk about something that shows up on a lot of paychecks: allowances. You know, when your company gives you some extra cash for using your car or for meals when you work late. It feels like a great little bonus, right? But is that money really all yours to keep? Or does the tax man get a slice? Well, that's exactly what we're going to figure out today. So let's dive right in with the most common one out there: the car allowance. Your company kicks in a few $100 a month because you're using your own vehicle. It seems like free money, but is it? The short answer? Well, it depends. And we're going to break down exactly what it depends on. All right, first things first, let's make sure we're on the same page. What even is an allowance? Put simply, it's money your employer pays you for using your own stuff for work. Your car is the classic example, but it could be your phone too. It's an extra payment on top of your regular salary. So, to make sense of all this, here's our game plan. We're going to start with the single most important rule when it comes to taxing allowances. Then we'll do a deep dive into car allowances, hit a few other quick examples like meals and clothing, and wrap up with the big takeaway for your paycheck. This brings us to the core concept, the one thing you really need to get. As far as the government is concerned, any allowance you get can only be one of two things. It's either a non-taxable reimbursement for a business expense, or it's a taxable addition to your income. That's it. Those are the only two options. And you can see those two paths right here. On one hand, you've got a simple reimbursement. You spend money for work, you show a receipt, the company pays you back that exact amount. No tax, clean and simple. But on the other hand, you have a taxable allowance. This is where you get a flat amount of money, maybe no questions asked. The government sees that and says, hey, that looks just like salary. And, yep, you guessed it, it gets taxed. All right, so let's put this rule to the test with the big one, the car allowance. This is honestly where most people get tripped up, so we're going to break it down piece by piece. The key word that decides everything is reasonable. But what makes an allowance reasonable enough to be tax-free? Here's the catch. It's got nothing to do with what you or your boss think is fair. It's all about what the government officially defines as reasonable. And it turns out the government has three very clear rules for this. To be considered non-taxable, a car allowance has to check all three of these boxes. 1, it has to be based only on the kilometers you actually drive for work. 2, it has to use the official government rate for each of those kilometers. And 3, you can't be getting any other money for that same car use. No double dipping. So what is that magic number, that official rate? For 2023, it was 68 cents per kilometer for the first 5,000 kilometers you drove for business. If your employer pays you exactly that rate for the kilometers you tracked and submitted, it's not income, it's just a reimbursement. Simple as that. Okay, so now that we know it's safe, let's talk about the red flags, the things that pretty much scream taxable income. The biggest one by far is getting a flat monthly amount, like $450, because it's not tied to your actual driving, it's just income. Using a rate that's even a little bit different from the government's, higher or lower, is also a red flag. And getting a flat amount plus a per-kilometer payment, definitely taxable. This table really lays it all out, doesn't it? The pattern is crystal clear. You stick to the government's per-kilometer rate for business driving, and you're in the clear. It's non-taxable. But the moment you get a flat amount, a different rate, or some kind of combo deal, it becomes taxable income. And that means you're going to see deductions taken off of it on your pay stub. Okay, I think we've pretty much cracked the car allowance. Now, let's see how that same reimbursement versus income rule applies to a few other common situations. Time for a quick lightning round. All right, picture this. Your boss asks you to stay late to finish up a big project, and they give you some cash for dinner. Good news. This is non-taxable, but only if you meet a few conditions. The overtime has to be at least 2 hours long, it has to be something that doesn't happen all the time, and the cost has to be reasonable. The government points to around $23 as a good benchmark. But what if working late 3 or 4 times a week is just your normal routine? Well, at that point, the government says it's not an occasional expense anymore. It's become a regular, predictable part of your earnings, and that means your meal money is now officially a taxable benefit. Next up, clothing. If your employer pays for a specific branded uniform you have to wear, with the company logo on it, or for required safety gear like steel-toed boots, that's a clear-cut business expense. It's non-taxable. But what if the dress code is more like a suggestion, like, hey, just wear black pants and a white shirt, and they give you an allowance for it? Well, that's taxable. And you might be asking why. It's because you have the freedom to choose the actual clothes. The government sees that freedom of choice not as a reimbursement, but as a cash benefit. Phew, We've covered a lot of ground. So now let's bring it all home and boil it down to the most important thing you need to remember when you look at your paycheck. At the end of the day, it all boils down to asking yourself one simple question about any allowance you get. Is this money paying me back for a specific, documented, and reasonable cost I had to pay out of pocket for my job? If the answer is a clear yes, it's probably non-taxable. If it's a no or even a kinda, it's almost certainly income. And why should you care about any of this? Simple. It hits you right in the wallet. A taxable allowance gets added right on top of your gross pay. That means it gets hit with all the usual deductions: income tax, pension plan contributions, EI, the works. So that $450 car allowance, after taxes, it might only be $300 in your actual bank account. And that's a huge difference. So, here's my challenge to you. The next time you get your pay stub, don't just glance at the final number. Look for any allowances and ask yourself, what's the real story here? Is this a true reimbursement for a business cost, or is it just extra income that's being taxed? Because now you have the tools to figure it out.